In this video, we are going to break down exactly what an adjusted gross income is and answer how it dictates your entire tax bill so that you can stop stressing over confusing tax forms and start keeping more of your hard-earned money. Let's get into it. So here's a quick outline of what we'll cover today. First, we'll define what gross income actually means, because you can't adjust what you don't understand. Next, we will look at the specific adjustments, also known as above-the-line deductions, that lower that number. And finally, we'll explore why your adjusted gross income is the ultimate gatekeeper to your tax refunds, and what that actually means for your wallet. Gross income, the starting line of your taxes. All right, before we can adjust anything, we have to know what we are adjusting. So let's talk about gross income. Gross income is essentially everything you make. The Internal Revenue Service, or IRS, considers almost all money flowing into your life as taxable, unless explicitly stated otherwise. We're talking about your salary from your W-2 job, the profits from your freelance side hustle, the dividends from your investments, and yeah, even that random $200 you made selling an old couch online. It all goes into a big bucket called gross income. It is the raw, unfiltered number of your total earnings before a single tax or deduction is taken out. When you look at it, it can be a terrifyingly large number, especially when you realize the government wants a slice of the whole pie. But don't panic just yet, because in a minute, I'll show you the exact adjustments you can use to shrink this massive number down. The adjustments, trimming the fat. Okay, now this is where the magic happens. We have our big gross income number, but nobody wants to be taxed on that full amount. This is where the adjustments come in. In the tax world, these are known as above-the-line deductions. Why above the line? Because they happen right on the front page of your tax return, mathematically above the physical line that calculates your adjusted gross income. These are specific expenses the government lets you subtract from your total gross income right out of the gate. Some of the most common adjustments include contributions to a traditional IRA, which stands for Individual Retirement Account. There's also the student loan interest you paid throughout the year, contributions to an HSA, which is a health savings account used for medical expenses, and even certain expenses if you're a school teacher buying supplies for your classroom. Now, keep in mind, you can't just deduct anything. Buying a new jet ski because it helps your mental health, unfortunately, doesn't count as an approved adjustment. But when you subtract the actual approved expenses from your gross income, the number you are left with is your adjusted gross income, or AGI. By the way, if you're getting value out of this video, hit like, subscribe, and tap the notification bell to get more valuable content like this. All right, so we've shaved down your income, but why go through this whole process in the first place? Stick around, because understanding what happens after we make these adjustments is the real secret to unlocking massive tax savings. The Holy Grail, why your AGI actually matters. So why is your AGI the single most important number on your tax return? Well, your adjusted gross income acts as a financial gatekeeper. It is the baseline number the government uses to figure out exactly how much you owe them or how much they owe you. Your AGI dictates your tax bracket, but more importantly, it determines whether you qualify for certain tax credits and deductions. For example, if you have kids, you probably rely on the child tax credit. But if your AGI is too high, that credit starts to phase out, meaning you get less money or nothing at all. The same goes for the Earned Income Tax Credit, or EITC, which helps low to moderate income workers get a bigger refund. Your AGI also sets the strict threshold for itemized deductions. Let's say you had massive medical bills this year. You can only deduct out-of-pocket medical expenses that exceed 7.5% of your AGI. So if your AGI is $100,000, you can only deduct medical expenses that go above $7,500. A lower AGI means you clear that hurdle faster, plain and simple. Now, we need to look at this from all angles. Some people get so obsessed with lowering their AGI that they actually end up hurting themselves financially. For instance, aggressively locking all your available cash into a retirement account just to lower your tax bill might leave you totally strapped for cash if an emergency pops up. It's a delicate balancing act. You want to legally reduce your AGI as much as possible to keep your taxes low, but you also need to make sure you have enough accessible cash to live your life comfortably. Okay, let's quickly summarize what we covered today. First, we defined gross income as the grand total of all the money you earned this year. Then, we looked at the adjustments, which are the specific IRS-approved expenses you subtract from that total, like student loan interest or retirement contributions. Finally, we learned that the resulting number, your adjusted gross income, is the master key that decides your tax bracket and your eligibility for valuable tax credits. For you, this means that calculating and tracking your AGI isn't just a boring paperwork exercise. It is the ultimate strategy to protect your hard-earned income, legally lower your tax burden, and potentially secure a much bigger refund. Just a quick disclaimer, I am not a certified public accountant or your personal financial advisor, so please consult a qualified tax professional regarding your specific situation before making any major financial moves. If you want to keep learning, check out this video next. Thanks for watching, and I'll see you in the next video.